Swayam Prabha. Digital India. Educated India.
We were talking about a very common money market instrument called commercial paper. This is a usance promissory note which matures at a particular time period and sold by companies for short-term funds. Short-term funds for a company are usually working capital requirements. And I explained why working capital is important. Yesterday I explained that. Now, problem was some RBI guidelines of 1997-98 financial year, which said that the net worth of a company has to be 4 crores. I explained net worth. Then it is CP issue is connected with working capital limit set by the banks for a company, and they are substitutes which create a immense problem. So the companies thought, what's the point of taking all this trouble selling CP if my working capital limit goes down by the amount I sell CP? Very funny clause in 1997-98 financial year that they did. And then of course, the usual ones that if you want to sell CP, the public must have confidence in your company so that you don't default payment or repayment of the money that you borrow. So you show the credit rating grades, the rates. So you have to go to a credit rating agency and get your financial health checkup and get a report, and then you can sell CP. And the other characteristic of CP was it was freely transferable and negotiable, which is a kind of a technical expression, essentially means ownership can change if you go to secondary market and sell it. So you can have a secondary market. You are not stuck with it. If you can find a buyer, you don't like it, you can sell it off. Now, over time, in 3-4 years time, what happened? They delinked from the working capital limit thing CP. So CP is in addition to working capital limit given to you by the banks. So CP can give you more working capital if you require. Number one. Number two, what they revised was the minimum issue size that can be sold to an investor. Initially, it was 5 CP, and each CP was 5,000 rupees, or no, 5 lakh. So 25 lakhs one has to invest to buy CP. That also was ridiculous. It was too much, too constrained. So what they did was, okay, minimum issue size would be 1 CP only. If you want to buy, you can buy multiple of 1, 2, 3, 4, 5, 6, 7, 8, 10, 20, whatever. No upper limit. No upper limit. Minimum is there. You have to buy at least 1 CP, not 5 CP anymore. This is also they did. Now, and then they revised the maturity period. It was about 6 months or so, from 30 days to 6 months or something initially, and no, 3 months to 6 months, 91 days to 6 months, which they made it from a fortnight, 15 days to 1 year. So that's a much wider range of the maturity period, much flexible. It can be 3 months CP, it can be 6 months, 7 months, 8 months, 8.5 months, whatever. So that also they improved. Now, if you look into the CP market, I will show you the data. It will see a curve lying like other deposits RBI's other deposits lied flat on x-axis for a number of years. So CP market didn't develop at all for the initial years, quite a few years. And then they took off and they are doing much better now. So the data I will show you. And then what they found that the CP, there are only, very interestingly enough, I am not going to do much research here, two types of companies were selling CPs. All right, two types of companies were initially selling CPs. One was the manufacturing companies, very few, and some financial companies, very interesting, were selling CPs, not manufacturing, so not working capital requirement. Financial capital selling CPs would quite very well be, they cannot have a lot of working capital requirement. They will have repayment requirements, financial companies, they are short of money for various reasons. So they were selling CPs initially. And the secondary market for CP was nearly non-existent. I don't know whether it exists now, hardly existed. So somebody bought CP, they didn't bother to go to the secondary market to resell it, because the maturity is for, initially it was 6 months. They didn't bother to go to the secondary market. And the reason for very small CP market and hardly zero growth CP market, as I have already mentioned, were the reasons that you already know. One was the working capital vis-a-vis CP money. Second was, a very stringent requirement was on the credit rating. You sold a CP, you got a credit rating done. Your CP is 3 months, 6 months old. As soon as 6 months is over, you will have to sell a CP again. The RBI said, which I didn't mention, that if the credit rating of your company is more than 2 months old, it's not valid anymore. Go to the credit rating agency and again get a rating done. The CP sellers had a huge headache. I don't know why Government of India or RBI would make rules like that. 2 months old only. If it is more than 2 months old, go and get a credit rating done. It costs the company. It's a headache also, because so much papers, so many papers have to be given information. Then they will judge and evaluate the financial health of your company. Sometimes they may be, the credit rating organization may be sending a person over to the company, sit there somewhere and do the job, collection of information, and you know how they do. They come and sit here, do the job, collection information, etc. And the company's people also may be attached to him or them to help them with all sorts of information, etc. that they require, other than periodic supply of chai and other things. So it became a headache. 2 months old, cancel credit rating. Again, pin banao usko. Then another thing was very interesting issue. This is an economics issue. If you are selling CP, all right, and there is a CP rate that will be market determined, how many people want to invest, how many people are trying to sell. Okay. Now, if that interest rate is higher than bank finance, all right, higher than the bank finance rate, where you can negotiate with a bank who knows you for a loan at an interest rate, in addition to the working capital, a short term loan or something, then it's not worth going to the CP market. So the CP rate is very important here in relation to the bank interest rate, the lending rate. They are competing. Suppose bank A has given me a working capital limit, but I know bank B, they know me. Maybe I can negotiate a loan, short loan, instead of going through all this credit rating, RBI permission to sell CP. go to the market, contact buyers of CPs and then sell them, and then the discount rate which is uncertain. So, I will look into the current interest rate or the discount rate of CPs. So, these two rates were competing with each other. So, unless the CP discount rate is substantially low than the bank lending rate, companies would have very little incentive to go to the CP market. It is an option, but whether I would use the option, if bank can give me money at a cheaper rate, why would I go to CP rate? Or if bank gives me or can lend me money at substantially higher rate than the CP rate, of course, I will go for the CP market and go and take that headache, go through that trouble and sell them. All right. And then of course, the minimum issue size was a problem of 25 lakhs. So, companies who had institutions which has a lot of money like LIC etc., were not interested, because they preferred on the one hand they made the issue size 25 lakhs initially. On the other hand, if you are expecting LIC to come in because it is 25 lakhs and not normally an investor would come in with 25 lakhs overnight, all right, has surplus funds of 25 lakhs, and you are expecting institutions like non-banks like LIC or UTI, which has lot more money, to come in, well, why would they? For 6 months, what's the point? I go into a long-term investment. They rather go to long-term investment because the insurance policies that they sell are very long-term. So, they know that the policy would, because of those policies that they sell, the premium would accrue over a long time period. So, they would have a long-term investment plan with that money, and they won't be interested in the short term. On the other hand, the issue size was too large, so small investors cannot come in. There was a problem. And then very interestingly enough, if you look into when you start working, at the end of the financial year, they will give you an income tax return obligation. The company may be deducting your income tax, but the company would also tell you that in order to save tax, you can make this kind of so-called investments or savings. You can buy LIC policy, you can make mutual fund investments, sometimes they are tax exempted, you can buy infrastructure bonds, you can buy national savings certificates from the post offices, and there are various kind of categories of investment that income tax office has in India. 80B, 80C, 80CC, 80D. So, various kinds of tax exemption clause are there, groups are there, where if you put money, then some portion of your income tax will be exempted. Now, even after when they made it 5 lakhs or something, would I be interested in putting money in CP? I would be interested if the return is very high. Second, I would be interested if there is some tax exemption, like a small investor I am talking about. If there is a tax exemption, infrastructure bond जो government sell करते हैं, they put a clause that the up to 1 lakh rupees of investment, there will be an income tax exemption of 20% or something, or 5%, 10%, your income tax will be exempted. CP unfortunately didn't have any income tax exemption clause, government didn't give that to CP. So, small investors were shying away from the CP market. So, it was a very underdeveloped market. Now, what we find when I look at the data, I have 2-3 years old data, I have been hunting for it, I am not getting it anywhere. I wanted to look into who are the companies who are selling CPs, and I found that more than 3/4 of the CP, 3/4, that means 75%, are being sold by leasing and finance companies. Companies which lease out machines etc. to smaller companies, manufacturing companies who cannot buy them. So, they rent machines for their business, for their production, and finance companies. There are various kinds of finance companies are there. There are finance companies who do hire purchase. You know hire purchase? You know, hire purchase, you want to buy a car, they would fund it, and installment wise you return that money to the company. This is hire purchase. Even the hire purchase, Indian middle class family used to buy household goods like refrigerator, furniture, refrigerator, then TV, many things you can buy through hire purchase. HIRE, hire purchase. So, these are various kinds of finance companies exist in a country. Now, these finance companies and leasing companies were primarily selling CPs in India. I have data up to 2009, I think. 75, 3/4. So, 75% of the total amount of CP have been sold by them. So, I will look into that data later. Manufacturing companies are very small, around 15, 16, 17%, and the rest are some financial institutions who are selling CPs. I wonder which financial institutions are selling CPs. Must be non-banks. I don't have the details of the data. I couldn't find it in RBI annual report. I hunted and searched and searched and searched at least 2, 3, 4 annual reports. I just couldn't find the CP details. Who are the companies selling them? If you find them, lend that data to me. I will pass it on. I just couldn't find which kind of company is selling CPs. I found some aggregate data which I have for 6, 7 and 8 financial year, maybe 9 I have added. Beyond 9 I don't have any data. All right, I will show that to you later. Now, CP market is done, and these are like discount bonds. They are sold at a discount and your interest is the discount rate. So, when it matures, you get back the face value of the CP. So, 5 lakh CP is maybe sold at a discount of 5%, say. If it is 5%, then how much of 5 lakh 5% will be? 5,000, right? No, 25,000, 25,000, 25,000. So 25,000 will your income if it is sold at 5,000 after 6 months, if you invest 5 lakhs. So, this is the way it goes. So, minus 25,000 you give to the company, 5 lakh minus 25,000 is 4 lakh 75,000, and when it matures, selling at a discount means this basically, and when it matures, the company gives you 5 lakhs. So, you have to wait 6 months to get your interest income. The discount rate is the interest rate, simple. All right. Now, I come to another one which is very similar. Its name is CD. It is very similar to CP. CD. CD is not your CD, the CD that you use, not compact disc, but this CD is certificate of deposit, CD, it is called in short CD. CD, CP names are rhyming words like, abbreviations, they are very similar also. So, I can explain this today, and then next day I will explain other instruments which will take much more time. CPs are sold by companies for short term funds. CDs is very interesting, are sold by banks for short term funds, and non-banks may also be included. Yes. All right. So, banks and non-banks, particularly long term instruments like IDBI, ICICI, they request short term funds, or financial institutions like banks, they can sell CDs. Banks can go to the call market, you have already learned that. Now, I am talking about another instrument which they can use, and also the big financial other institutions, non-banks like LIC, UTI, GIC, you name them, these industrial development banks, SIDBI, IDBI, ICICI, then Industrial Reconstruction Bank of India, IRBI, the various banks are there, non-banks. If you want to look up the list, you can open Bole's book and you will get them. In fact, details of them also individually. Very interesting to read them. Now, these institutions, these financial institutions, if they require money, some of them can use CP, but most of them will not be allowed CP, they would be selling CDs. Very interesting, I should have had this first. CDs were introduced a year before CPs. In 1989 they were introduced to the Indian money market. Till quite recent, this CP CD existed in the Western world, God knows for how many years. To the Indian money market, is still a new thing, 20, 22 years old, 23 years. The CDs were introduced as use promissory notes, and they are very much like bank fixed deposits. They take the money, it's fixed for a shorter time period, like a very short term fixed deposit, and it carries a fixed interest rate which is and has a maturity period. And they are also freely transferable and negotiable instruments. You can sell CDs in the secondary market. This is unlike a fixed deposit. If my fixed deposit is there in the bank has that money and I cannot have it, but I can break it at a cost. But I can, the fixed deposit, I don't need it here, I can sell off that fixed deposit to somebody else and go and open a fixed deposit account in another bank. Cannot do that. But CDs are like use promissory notes. It's like a bond paper lying with me, and I can go and sell it. All right? But they are very much like fixed deposit. Money is stuck for a shorter period of time. Now, and they can have a secondary market. And since banks are involved with CDs, practically risk free, because banks in India, primarily we are talking about public sector banks and big non-banks, nobody mistrusts them. Nobody, what you call that, they all trust non-banks, this kind of non-banks and banks, so they can buy CDs. According to the RBI guidelines of 1997-98, banks can issue CDs without any upper limit, and anyone can purchase them. The minimum denomination of CD, just like CP, was 5 lakhs, and the minimum issue size to a single investor, unlike CP, was only 10 lakhs. Very interesting. ये देखो, bank CD could sell a minimum issue size to a single investor of 10 lakhs, that means 2 CDs they have to buy, whereas in case of CP they made it initially 25 lakhs. So when I read them, I really don't understand. Why would somebody like RBI, such a wise institution, would make rules like that? CPI companies are not like banks. They don't have so much cash, even if the company is doing well. And if they need cash, all right, they made it initially 25 lakhs. And CD, bank sell kar rahe. उनके इतना source है of funds, RBI है, other banks है like call market, and this much. Minimum issue size was 10 lakhs. So it was a multiple of 5 lakhs every CD. That's the same thing. Maturity period varied between 3 months and 1 year. In case of CP, the maturity period was 91 days to 6 months initially. Now it was right from the beginning, it was 3 months and 1 year. Much more flexible, you can see. And if you look at the data CP and CD market side by side, you can clearly see the difference in the amount that they are transacting to this instrument. CP को शुरू से ही suffocate करके रख दिया. So many stringent clauses were there. Then they relaxed 3-4 years later. CD, right from the beginning, they were much more flexible. Maturity period is from 3 months to 1 year, right from the beginning. Minimum issue size 10 lakhs, that means 2 CDs you have to buy, that's it. Minimum, upper limit to hai nahi. Okay. Then around 2001 and again in 2005-6, about 6 years back, they reduced the maturity period. This is very interesting to make the market competitive with call market. They reduced the maturity period to 7 days, minimum maturity period. So it can fluctuate between 7 days and 1 year. That means 1 week to 52 weeks in a year. It can vary. So much flexibility CD market may. Now, as before, as I told you, CDs are sold at a discount, all right, and the discount rate is market determined. Okay. Banks consider them usually a very short term time deposits. All right. Now, CDs are freely transferable, but in case of CD, I don't know whether it is still there, as opposed to CP, they had a lock-in period of 30 days. Lock-in period means what? Once you buy the CD, for 30 days, 1 month, you cannot go to the secondary market and sell it. All right? You cannot go to the secondary market and sell it. For 1 month, it is locked in. All right. Now, I will talk about a type of banks that exist in India, and I haven't given detailed description of Indian banks. They are called RRBs. They are commercial banks, but RRBs usually you and me who live and grow in an urban area don't know. Indian language for RRB is Grameen Bank. They are commercial banks. I will talk about them later. You will find them mostly in semi-urban rural areas. RRB means, the full word means regional rural banks. I will talk about banks in the last topic. Now, RBI gave permission to all scheduled banks to sell CDs, but not RRBs, remember. Because RRBs have always been financially very weak. And if they are given the right to sell CD, they may start defaulting it, because their fund management is very poor. RRBs don't. The primary reason probably is they fund agricultural activities where there is a high rate of default or non-performing assets, what they call. Money is given, money never comes back to the bank. It's eaten up. All right? Because of this also, you have the farmer suicide cases. They take loan not from RRBs. It would be better. They're taking loan often in the private money market, unorganized money market, from money lenders. And then they cannot return, and then they get into trouble. So RRBs, remember, all banks were given permission, but later when you mature in this course, you realize there is another set of commercial banks which were created not many years ago, which are new to Indian economy, called RRBs. So the question may arise, do RRBs sell CDs? No. RRBs were not allowed to sell CDs. Now, here's a very interesting thing. Last one or two points. Once a CD is sold by a bank, it's not like a share certificate that bank can call it back. Now I don't need the money, return the money, I give you a little bit of interest. It cannot happen. It has a very fixed deposit type character. It matures on a particular date. It's a usance promissory note, like a bond or a fixed deposit. It has a fixed maturity period, and a discount rate is market determined. It cannot change the discount rate. All right, you're going to change. Sorry, आप जब खरीदे थे 5% था, लेकिन अभी तो डिस्काउंट रेट भाई 2% हो गया, आपको खाली 2% इनकम दूंगा. It won't happen like that. It's very fixed interest rate. The interest rate that is mentioned on that paper or at which you buy, the discount rate remains there. Even at the time of maturity, if the discount rate in the market has fallen. Banks have promised that and will pay that interest. All right. Secondly, if they sell CDs, it cannot be bought back like a share. Third, if you sell CD, then suppose you buy, I am a bank, I buy your CD, your bank CD, your Bank of Baroda, I am State Bank, which State Bank often does. I buy Bank of Baroda CDs. Now, I cannot show that CD as an asset and lend against it. Like unka bank ka CD hai mere paas. CDs cannot be used as collateral. CDs cannot be used as collateral. C-O-L-L-A-T-E-R-A-L. Learn this language. The term collateral. Collateral means something which is valuable, tangible asset that you keep with bank when you take a loan. Suppose I have a house and I need a loan. I mortgage my house to the bank. That is showing my collateral to the bank. A company borrowing money from a bank. The company will have to show collateral to the bank. Security, essentially. So that in case I default, bank might take that, confiscate that valuable, tangible asset, sell it at whatever price they can, and recover as much money as possible from towards that loan that they gave to you. So if I'm suppose today I want to go to the bank and ask for a loan for a flat, they might mortgage my flat till I bought a flat, I start living in it, but the flat is still not in my name. Flat is still in the hands of in the possession of the bank. Once I have repaid the entire amount, all right, the loan is over, then I take possession of that property. Similarly, I am going to go, there are advertisements of TV I have seen. I can take my gold, jewelry, other valuables, properties and show them as collateral to the bank when I want some money. It is often happen. Companies also do that. Now, you cannot use CD as a collateral. CDs are very valuable assets, money market assets, but CDs cannot be used as collateral, although it has a fixed maturity and a fixed interest payment, which is very risk free. Even if it is risk free, RBI doesn't want that to be used as a security against which somebody can borrow or lend or whatever. All right. Last point, since the banks are there, say buying and selling CDs often, buying and selling both they are doing, because State Bank of India, for instance, always has surplus cash. And when Bank of Baroda or Canara Bank wants to sell CD, it's often another bank like State Bank who purchases them. So now, if you have CD money with you, Bank of Baroda, she has sold, I made her Bank of Baroda today, tomorrow I will make her some other bank. So if she sells CDs and she has cash, RBI says, aha, this is just like fixed deposit. Show the CRR and SLR on that. RBI doesn't exempt that money from CRR, SLR. Like when banks accept mine and your money, she or the bank will have to show the CRR and SLR to RBI. Can keep CRR with RBI and show SLR. I will talk about that later. In case of CD, if she sells CD and collects some money, short-term funds, she will still have to show the CRR and SLR to RBI. But in case of CP, the private companies, corporate sector selling CP, there is no concept of CRR or SLR there. Or when they sell shares and take money, there is no concept of CRR and SLR, which they have to show or keep with the company board or Securities and Exchange Board of India or something. Capital market में है नहीं, लेकिन in case of CD, where banks are primarily involved, they have to show. So what happens if a non-bank sells CD or CD? Banks do not only sell CD. If non-bank sells CD, I think this is a universal rule. Non-banks suddenly will have to show CRR and SLR. So CDs universally in India, whoever sells them and borrows money in the money market will have to meet that obligation of CRR and SLR. All right. Acha, have you understood the CD market? All right. Now, when I looked into the data, who are the institutions buying CDs, I have found a general institution like mutual funds. Mutual fund can also be a business of a commercial bank, you know that. Commercial banks can open a subsidiary which does business in mutual fund. That is not banking business, that is a mutual fund. Commercial banks have diversified. You understand diversification? I just don't produce cars only. I produce motorcycles also today. Diversification. So commercial banks these days have diversified a lot. So although their main activity is commercial banking activity, but they have also diversified into mutual funds. That I am seeing from 1980s or 90s. So the main investors in CD market, because it is so riskless market, big banks are involved, non-banks are involved. What I have seen, the main buyers of CD or investors in CD are mutual fund companies. Mutual fund companies. There are lots of mutual fund companies. One advertisement is often I see these days on TV is Birla Sun, mutual fund company. Birla Sun, you will see that on TV often. Earlier it used to be SBI Magnum, Canara Can, then UTI, the public sector mutual fund company. UTI is a government company. All right. The main investors here are mutual fund companies who also have a lot of cash to deal with, which they want to invest. So, more or less this is the CD thing, which is very similar to CP, but there are important differences between the CD and the CP market. Now I come to the one of the most complex markets. Initially it has become simpler now, the treasury bill market. But it is 242. Treasury bill market will require an entire lecture to be delivered. This is the government bill market. So I need to go through that very carefully.